Hello and welcome to another video on accounting. Now, just like any other field, accounting is based on certain concepts and principles. We will discuss 4 accounting concepts and principles in this lecture today. They are the historical cost principle, the going concern concept, the monetary unit concept, separate economic entity concept. We'll explain each one through examples so that it's easier for you to understand them. Let's start with the historical cost principle. Imagine that the business purchased a property at $100 million 10 years ago. The current value for that property is $120 million. The question before us is, should this business show its asset, this property, at $100 million on the balance sheet as an asset or at $120 million? Now, to answer this question, the cost principle tells us that we need to record our assets at their original cost, i.e. the price or the cost that was paid at the time when it was purchased. So we should record this asset at its original cost of $100 million, not at its current market value or fair value of $120 million. Now, using historical cost principle has some advantages. One, that the cost or the amounts are objective and verifiable. We can always go back and confirm that the value of this property is $100 million. We can confirm that from the invoices or any other documentation related to this property or asset. Another advantage is that it is easier for record keeping. There is only one value that we need to keep track of, the initial amount. And we do not need to keep updating our accounting records to show our current values. However, there is a serious drawback. Now, the drawback comes to the lack of accuracy. You can see that the current market value of this asset is 120 million, not 100 million. So 100 million is not the right or accurate figure. And this means that we are not providing, if we record our asset at 100 million, we are not giving the users of the financial statements accurate information so that they can make their own decisions. Now, that is a drawback. Let's look at the next one. Imagine a business having some problems. It's making losses, liquidity issues, labor problems, unable to pay or refinance loans, a key customer has stopped trading, there's a loss of license or patent, legal problems are going on, and there is a major fraud. The question arises is, should financial statements be prepared on a regular basis? Now, to answer this question, the going concern concept tells us that a company will continue to operate for foreseeable future because it is financially stable enough to continue for foreseeable future. Now, we assume, going concern concept, by the way, is the underlying concept. It assumes that the company will continue long enough to be able to use whatever asset it has purchased and settle its liabilities. So the asset that, or the property that was purchased for $100 million, we assume that the company will be able to continue to use it unless there is evidence otherwise. So if there are substantial doubts as to the existence of this, as to the ability of the company to continue, the financial statements will not be prepared on a regular basis. Now, all of those problems that I mentioned, individually or collectively, might cast a substantial doubt on the ability of the company to continue, and therefore financial statements will not be prepared on a regular basis. They will be prepared on any other basis, such as liquidation basis. So the asset that will not be reported at $100 million, but rather will be reported at a liquidation basis, which is at whatever price it can be sold for in the market. Moving on to the third one. In a business, there are many things happen on day-to-day basis. Companies hire people, companies talk to suppliers, meet customers, company purchase new equipment, make sales. Now, which of those will be recorded and shown on the financial statements? Well, monetary unit concept tells us that we record and show them on the financial statements only those transactions that can be measured in monetary terms. Only those transactions that bring a change in the assets of the business, liabilities, or owner equity of the business. If there isn't any change, we will not be recording that event or transaction. For example, hiring employee does not bring any change in assets, liabilities, and owner equity of the business. Neither does calling suppliers. However, buying new equipment or making sales does bring change in the assets, liabilities, or owner equity of the business. So that should be recorded, but not hiring and calling suppliers. Lastly, separate economic entity concept. Let's discuss this through an example also. Suppose that the owner of this business had a family dinner and the dinner cost $150. The next morning, the owner goes to his business and hands over this receipt to the accountant and asks the accountant to record this as an expense in the business. Should the accountant record this as an expense in the business? Now, the answer is given by separate economic entity concept. Now, it tells us that we need to keep separate the records of a business and keep the records of the owner separate. We will be preparing financial statements to show only the records of the business, not the record of the owners in the business. So personal transactions or personal activities of the owner will be kept separate and will not be included in the accounting records or financial statements of this company. Therefore, that $150 will not be recorded in the business, because that's an owner's personal expense. We only will be recording personal the business sales business expenses, not the owners, and mix it up with the business. However, we need to keep track of this, that for legal purposes, remember that legal purposes, the owner and the business will be the same. That we need to keep track of. So this is essentially for sole proprietorship and partnership, because they are not considered separate from their owners for legal purposes. For accounting purposes, they are considered separate. However, for legal purposes, they are one and the same. So these were some of the accounting principles. Hopefully you have learned, and do watch the video again and again, and don't forget to like, subscribe, and click the notification icon for more videos. See you in the next video.